Welcome everyone. I know there's plenty of people still coming online. Great to have you all on board so far. Thank you for joining right on the dot at 11:30. I'm going to introduce our hostess with the mostess, Ali Kane. Great to have you back, Ali. Want to join?
Good morning, Pat. How are you?
I'm good. How are you doing?
Very well, thank you. Happy first of summer.
That's it. A little bit overcast, but it's warm, not raining. That's all we can ask for.
Absolutely.
So look, I might pass over to you. We've got a fantastic panel lined up today, really good discussions coming, and there's two parts to it as well. So as always, thank you to everyone for joining the CreditorWatch webinar, and thank you to the panelists who put in plenty of time into the risky business webinar itself, but also the white paper. And Ali, over to you.
Thank you so much, Patrick. So good morning, everybody. Welcome to today's CreditorWatch webinar, Risky Business and How to Avoid It, Financials Stripped Bare. As Patrick kindly introduced me, my name's Ali Kane. I'm a finance journalist and your moderator today. Before we begin, I'd like to acknowledge the traditional custodians of the land that we're all on and their leaders past, present, and future. So as one of my colleagues on the Sydney Morning Herald wrote recently, if you can't smell bushfire smoke, if you can walk out your front door without getting fined, and if it's not torrentially raining, you're probably going to have a pretty good day. So the question is whether the economy is going to have a good day. Now, there was unexpectedly good news yesterday when inflation numbers came in quite substantially below expectations, but people are still doing it tough out there, especially sectors like construction. So what can we expect from the economy as we head into 2023? I should mention that the springboard for this session is a white paper, Risky Business and How to Avoid It. And you can download that from the CreditorWatch website right now. So a little bit of a change for today's webinar. We're going to split it into two. In the first part, I'll be joined by an esteemed group of panelists who I'll introduce in a minute. Part two is an opportunity for me to introduce Matt McFedries, the co-founder and CEO of Debtor Daddy, which CreditorWatch recently acquired and which is now known as CreditorWatch Collect, a customizable solution for automating invoicing. And in such a risky business environment, it's never been more important to keep the cash flowing, and CreditorWatch Collect is one of the ways that you can do that. And I'll be interviewing Matt in the second half of this session. But at this point, I'd like to introduce our panelists, and if I can ask everyone to please turn on their webcams now. So obviously you've met our CEO, Patrick Coughlin, CEO of CreditorWatch. I'm also joined this morning by Nick Pilavidis, the CEO of the AICM. Good morning, Nick. How are you?
Great, Ali. How are you?
I'm well, thank you. Very nice to see you. Roberto Bastos, Head of Rating ANZ for Coface. Good morning, Roberto.
Good morning, Ali. How are you?
I'm well, thank you. Thank you so much for joining us. And of course, John Field, CEO of Reworq Consulting. So nice to see you this morning too, John.
Nice to see you, Ali.
Okay, so let's kick things off with you, Patrick. So what are we seeing out there in terms of business conditions? How are things looking?
So unfortunately, but also fortunately, you probably hear some beeping in the background. There's construction going on. So despite the fact that the media is talking about the death of construction, I can tell you that in the road that I'm in, there's about 6 or 7 houses all getting work done on them at the moment. There's a big truck reversing up with the beeping, so I apologize for that. So look, it's a funny sort of time. We obviously put out our business risk index sort of the middle of every month, and things are changing quite quickly. There's certainly a lot more optimism, I think, in the economy than there was probably a month ago, and I think we would have seen an improvement off the back of the inflation number that was out yesterday, and hopefully That's some good news for the RBA after copping plenty of grief, understandably, over the last sort of 6 or 7 months. Look, from an industry perspective, I'm catching up with as many industries as possible at the moment, either associations or leaders of large companies. Construction will remain under the spotlight for quite some time. Obviously, December, Jan is a really important period for retail and hospitality, particularly through December. Anyone who's servicing those industries will be keeping a close eye on it, and then of course we'll be keeping a close eye on the numbers as we come out of that Christmas January period. I think from a finance perspective, lots of people rolling off fixed rates, as we know, and it sounds like the bank numbers are really positive. The ABA, talking to Anna Bly a couple of months ago, said the numbers coming out of the banks are really positive, but they're all looking at sort of Feb, March. So Q1 is going to be really key. And what's really good in some positive news, that the ag industry, manufacturing in Australia is still performing really nicely. So hopefully we can put sort of bushfires and floods and whatnot behind us and have a little bit of clear air going forward.
I think everyone really is looking forward to that after 2 pretty tough years. So we've had a little look at industries, but what about geographies? There's often the usual suspects in the numbers. The Gold Coast often is sort of a boom and bust area. What are your figures showing, Patrick?
Yeah, look, the top 10 worst when we talk about geographic regions is dominated by 2 areas still, and it's been like that for over 12 months now. So that's Gold Coast, Coolangatta region, as you said. Obvious pressures on that. We've spoken about it a lot. There's high costs, high commercial, residential rents. It is a boom and a bust town, and they're still very reliant on international tourism filling the gap. Domestic tourism doing a really good job of that, and no doubt plenty of people heading up there through December and Jan, which will be good. And then of course Western Sydney, doing it really tough there. There's various reasons for that. Again, rent and housing costs, cost of living, but then a lower socioeconomic sort of area in general. And then there's one outlier. So there's nine sort of traditional areas in that Western Sydney, Coolangatta, Gold Coast region, and then it's Melton, Bacchus Marsh. So that's the one standout. I think they're in 2nd or 3rd. But from a positive perspective, and we're all about positivity nowadays, we're looking at regional areas doing really well. Capital cities still, faring, doing a little bit tougher, but it certainly hasn't been as bad as what everyone is expecting. So I think let's just get through December and Jan, and everyone will be reassessing for the first sort of half of next calendar year.
Patrick, I know that you talk to a lot of businesses and you've got your finger on the pulse. When you go out there, what are businesses fearful of? What are they really worried about as we head into 2023?
Yeah, look, there's less uncertainty now than there was, a bit over 12 months ago when the East Coast was locked down, and it was a question of, when are we going to get out of it and what's that going to look like? So I think they've got a little bit of a clearer view of the future, which is really important, particularly for investment and hiring. I think what we're seeing is there's definitely a tempering of investment at the moment and hiring. So that's including, upgrades to technology, hiring people, or buying new assets. I think people are just sort of want to see what's going to happen next with interest rates, what's happening with inflation, and then they're in a bit of a holding pattern. But it's a positive holding pattern. I think Australia's we know we're resilient, quite optimistic about fortunately having a huge amount of valuable dirt and coal and gas and whatnot buried underneath the ground, which will sort of cushion any sort of blow. So yeah, I think it's a kind of wait and see at the moment, and I think it'll be a sort of shallow in, shallow out type of downturn.
It seems, crazy that only 12 months ago we were still under quite severe restrictions. So it's almost a miracle how well the economy's done. since then. So I'd now like to turn to you, Nick. You're also at the coalface and really have your finger on the pulse of what's happening with businesses. So what are your members telling you about how the economy and the commercial sector is faring? Just unmute yourself, Nick.
As long as keeping the lights on, got to turn the volume on as well. So yeah, thanks for having me part of the webinar, and it's great to support CreditorWatch's webinar. They often support us with what we do for members as a national partner and supporter of everything we do, from the Credit Professional of the Year to the conference last month. So yeah, the conference last month, we had over 400 credit professionals coming together and sharing what they're experiencing and what they're thinking about coming up. And I think the opening of the white paper sums it up really well, that there's a plethora of risks out there. I was just at a summit in Canberra yesterday with the Chamber of Commerce and other industry leaders there as well. And the theme there is all the risks globally and locally and at an individual level, as Patrick sort of highlighted there, and we can list those all off because it seems to be ever growing. There's more and more things to be worried about. But also there's lots to be positive about. We are in a very lucky position in Australia. We punch well above our weight globally, and as Patrick said, there's lots of positivity in the economy with full employment and various sectors doing very well, and strong fundamentals to the economy that will hopefully see Australia track well going forward. But saying that, talking to our members, I think they're definitely feeling the impacts of that unprecedented volatility and uncertainty. There's signs of that flowing through to them at the moment, with arrears levels starting to increase. Disputes are starting to increase as well. I'm hearing that a lot from members, and that can be a sign of cash flow tightening up, that customers are starting to raise issues that may not be valid, and then obviously throwing through to payment times increasing. So they are starting to hear those sorts of signs come through, but we are coming off a historically low base with those sorts of numbers. So a bit of a sign that what we're hearing about with those risk factors are starting to be felt. Obviously, insolvencies are coming back. It's going up and down, but from what I'm hearing from members is that seems to be largely impacting the ATO more than other creditors, and especially unsecured creditors, that they seem to be largely paid up to date, even when those businesses folds, and it looks like that ATO action is seeing those unviable businesses exit the market. And along with that, hearing a bit of commentary from members recently about the small business restructuring plans. So that they're quite low numbers at the moment, but they're starting to flow through to members. So that's probably a good tip to think about and make sure you're across those, because they're the same as other insolvencies, but very different at the same time. So good to touch base on what's involved there. But again, it seems like the ATO's the one making most compromises. Most creditors already paid up to date or largely paid up to date when those start. There are a few things I'm hearing as I talk to our members.
So Nick, off the back of that, what are the main issues that your members or your CFOs and credit managers and risk managers are dealing with at the moment?
Yeah, I think there's three things to sort of break that down and how they're being impacted at the workplace and in their day-to-day roles. I think one's that volatility and uncertainty. They're keeping a customer-focused approach and keeping focus on the customer and maintaining capacity. So if we walk through those, we're constantly hit with new risks and challenges and things to consider in an organisation. And credit managers, that's what they do day in, day out. There's a problem, we jump into it and we fix it. So often members say they feel like they're fighting fires. But recently I've heard a few more members say it feels like we're jumping at shadows now. So
Right.
Not jumping to fight fires, but jumping at shadows. There's another thing here, something else is happening. What are we going to do about that? And whether or not those things actually come to fruition, because there's so many different dynamics. And as we said, cost of living and energy impacts a lot of people and businesses, but it doesn't impact all of them. Others are going really well. So you really need to dissect all those things based on your customers. And that sort of makes us very internally focused and looking at what we're doing and thinking about it and challenging and sort of spinning your wheels internally, when really we need to be out talking to our customers, talking with our internal teams, our sales teams that have so much information our peers, our fellow credit professionals that pick up the phone, or seeing them at a function, or chatting to them online, or however you interact with your colleagues and peers. You'll get clarity very quickly by talking to people, and obviously organisations like CreditorWatch and others that have those solutions to a lot of the problems that we're facing, and the data to be able to make those decisions. So I think that's something that we need to do, is to keep focus on those things and asking those questions of the customer. That's really what we're here to do, is to engage with customers. It's not only going to get us paid, but it builds that relationship, it drives more sales, and importantly, it protects the company reputation, which is what takes me on to capacity. That we've been through these 2 years of change and uncertainty, and throughout that time, everyone was at full capacity, but payment times were the lowest ever and bad debts were the lowest. So we weren't really needing to do that sort of collection activity that we've had to do in the past. Now, as risk and payment time increases, that need to engage with customers is increasing week by week, basically, as we get more concern, more pressure come through. But we've only got that same capacity that we've filled up with all this change and the pace of change, implementing new processes and procedures. That's all there. So then you overlay the challenges recruiting new staff and filling vacancies. Leaves me a bit of a concern that if we're internally focused and not having that capacity to spend time with our customers and externally, that's probably a risk that I'll be worried about as a CFO, because that means those important things that credit professionals do might have to fall by the wayside, and that can increase risks and stops us engaging with customers. And we all know what happens when that happens. You get reputational risk, you get more bad debts, and it makes it harder for the organisation when that cash flow is not flowing through like it should be. So yeah, I think that's my main thing. Keep that customer focus, keep focusing on customers, engaging with them, and asking the questions about how they're travelling, and really understand how things are impacting them as a business.
Thanks so much, Nick. That's a good segue to Roberto. So Roberto, trade credit insurance is important in this sort of environment. So what is demand like, and what's driving that?
All right, can you hear me?
Loud and clear.
Lovely. Thank you, everyone. A pleasure to be here today. So demand for trade credit insurance is gradually increasing at the moment, right? So what I can say is that in the last 3 years, we saw different behaviors from market participants. So at first in 2020, when COVID first came out, there was a sudden spike in demand for trade credit protection. But at the same time, the insurers' risk appetite went to zero, as no one knew what was going to happen, right? Then in 2021, you had vaccination being rolled out worldwide, and combined with aggressive fiscal and monetary measures. And at that point, insurers' risk appetite was high, but companies were living a good momentum, and they decided that self-insuring was perhaps a great alternative, believing that good times would just continue for a while. Now in 2022, we are facing a new challenge, as inflation is going up, and we have monetary policy in a tightening course. There is a fundamental difference between the challenges we face now and what we saw back in 2020. At the end, this COVID thing was a black swan and nobody knew what to expect from it, but now things are different, right? So we are looking at a cyclical slowdown, a recession, and that's an environment that we know how to operate. Business have been through this before. And so demand for credit insurance is increasing once again. So we do believe that we'll continue to ramp up towards 2023 as we see more insolvencies happening in Australia.
Thank you so much. So now let's have a little look at industries that you're seeing use trade credit insurance. Where are you seeing demand?
Well, so trade credit insurance is a disseminated product across most industries. So from a supply chain perspective, in some industries, you'll see more in the upstream part of the chain. And in other industries, you'll see across up, mid, and downstream operators insuring against credit losses. But having said that, historically in Australia, just like Patrick mentioned, construction sector is the champion, and it's the sector where there is more demand for trade credit insurance. However, in the last 2 years, there was a spike in demand for credit insurance in sectors such as hospitality, aviation, hotels, of course, associated with the lockdowns and the mobility measures that were imposed. And even though we are out of COVID at this point, more or less, there's still a high demand for insurance in those sectors.
Great. Just very quickly, how do you see the outlook for next year?
Well, that's definitely the most important question of all questions at the moment, but also the hardest one to answer, right? So in Coface, we expect a cyclical slowdown to take place, as cost of capital will increase in the short term. And it's not clear yet what will be the RBA terminal cash rate and if we'll see interest rates dropping to the levels we saw pre-COVID anytime soon. So high interest rates will fundamentally reshape the landscape and impact sectors and companies with low profit margins, right? So it's reasonable to expect higher insolvencies in the next year, but very difficult to assess the depth of this slowdown, right? And even though commodity prices have come down a little bit from their peaks, they're still relatively high compared to their historical averages. And that, in fact, has a net positive effect for the Australian economy as a whole, but for some sectors, it's particularly bad, right? We expect in 2023 to see global supply and demand imbalances to further normalize. We also see the Australian consumer a little bit more diligent on its spending going ahead, responding accordingly to the change in the risk environment, especially as unemployment is expected to go up a little bit. And obviously that will filter through to the retail sector, will impact the weaker end of the sector naturally. So just to summarize now, we see the Australian economy growing through a slower growth period in 2023. And associated to that, inevitably, we see higher business insolvencies and payment defaults, right?
Great. Thank you so much, Roberto. So let me move now to you, John. Working capital is absolutely key in this sort of environment. So how do we protect cash flow when things are uncertain as they are at the moment?
Yeah, I guess it's a pretty exciting time for businesses that come out of COVID. But I guess in hindsight, what COVID actually did, or the pandemic highlighted, was a fairly, I guess, moderately conservative strategy around cash management. But the key lesson really is that critical importance for best practice principles and how they can safeguard cash and liquidity management. So the timing with that has also created, I guess, an incredible opportunity for CFOs and executive teams, is that they can actually look at evaluating their cash management capabilities. And there's a focus now from what is actually, I call cash preservation, towards a future state of what is cash excellence. So we know that working capital, it's a lifeblood of every organization. But most organizations have about between 15 to 20% of total annual turnover, which is actually tied up in that balance sheet. It actually equates to poor working capital management, poor processes, poor systems. So all successful working capital approaches begins with a creation of what is an overall, I guess, organizational strategy, a vision. And what that does is in turn, it actually provides a policy and drives a policy framework. So process and policy, the framework, it's actually a guide for your organization to meet goals, simply. But strategy has to be aligned to those goals. Otherwise, it makes no sense. Strategy, it's simply focusing on business performance, and it's about releasing that excess cash that's tied up in working capital, because it's actually a really cheap form of finance. There's no requirement to get any procurement options with finance. It may be an option, but remember, it's all fit for purpose solutions. And it's about how you actually access cash. How do you unlock that free cash that's sitting in my balance sheet? I just need to look in the cupboard and try and find it. So it's a strategic approach, and it's really about initiatives in probably 4 areas: treasury management, or cash and forecasting, liquidity management, accounts receivable, accounts payable, and inventory. So CFOs, executives, it's about challenging your own organizations, challenging the stakeholders, the departments, people, try and do your homework. And there's 3 areas. So firstly, it's about optimizing the value that's actually in the cash conversion cycle. Secondly, the robust processes drives responsibility, but it actually drives accountability to deliver working capital. And thirdly, there's a clear understanding of any gaps that are in working capital, because what it does is it provides a clarity around that residual funding gaps and which may need financing for your business.
That's great. Excellent advice. A quick question for you, Patrick, before we introduce Matt. What's your advice to businesses to mitigate the risks in the environment?
There we go. So what we saw very early on in COVID, in those first, sort of call it the first 6 months, was small and medium businesses, and they're when I say small and medium, they're the traditional ones that probably don't have a full-time credit professional in there. So Nick and AICM represent all credit professionals, but generally you get to a certain size where you realize, okay, now we need a full-time credit professional, accounts payable or credit manager within the business. So what we found is those on the below that, maybe just on the brink, we've just got to save all dollars. We don't know what's going to happen, in the coming months, coming years. Just cut everything. So for CreditorWatch, for example, it was more of a challenge to obviously get more customers in that space. However, for those organisations that had a credit team, generally slightly bigger organisations, and then up into banks, fintechs, lenders, they really understood the power of data, right? So they were like, great, we need it from A, B, C, and they just wanted to get as much in so they could, really protect their book and still be able to trade and have confidence in bringing on new customers. So that was a really interesting sort of nuance through those early, the early sort of 6 or so months of COVID. What we've now seen in the last 6 months with this, downturn, come out of COVID, lockdowns, etc., is it feels like small and medium businesses have learned from that, and they're not. While I'm sure they're cutting costs, we're not seeing that within our business. We're actually seeing them embrace the need for more data and also automation, which obviously lead nicely to the discussion that you're going to have with Matt about CreditorWatch Collect. But it's great to see that small and medium businesses in particular are starting to understand, the more data we have, the better decisions we can make. And of course, larger organizations that I spoke about are still trying to pull as much data in as possible. So I think that's really good to see, and I think that is key. Arming yourself with information is really important through sort of uncertain time. Getting best of breed advice from the likes of John and Nick and their organisations is really important too. And of course, there's options out there with the likes of Coface from a credit insurance perspective, which can be, I think, Rob, you probably agree here. I think people feel like that can be quite daunting, but it's actually really quite easy to have a conversation and understand, what's necessary, and understand how it will fit a business, whether you're operating a small one or a really large one. So I think that the key there is we've learned not to bury our heads in the sand, and we've learned to go out and get either expert advice from experts like the panel that we've got here, or utilize technology and automation to help make better, faster, more streamlined decisions.
Excellent. Thank you very much, Patrick. That's an excellent introduction for me to now bring Matt McFedries into the session, and to say thank you so much to all our panelists for a fabulous discussion this morning, and I know the audience will have been able to get a lot out of it. So I'll ask the panelists now to turn off their cameras as I introduce Matt and talk about some of the issues that the industries are facing in terms of cash flow. So good morning, Matt McFedries. You're going to talk to us about everything we need to know when it comes to small business and cash flow. So what does good cash flow mean? If you are a small business, what difference does it make to your operations?
Yeah, well, I've been a small business owner a couple of times myself, and I'd say number one would be less stress. Like when cash is tight and you're wondering how you're going to meet payroll, pay your bills on time, it's all consuming, and it takes your eye off other opportunities in terms of where you could direct your thoughts. And then, yeah, ultimately, the more cash in the bank, the reality is you can do more in your business. You can take on more jobs, you can buy more stock that you can sell, you can hire a person. So it's, you know, it is the lifeblood. You know, it sounds cliche, but it directly is, for sure.
It's the sleep at night factor, isn't it?
Yeah, absolutely.
So we know that businesses that are struggling with their cash flow, the obvious problem they have is they can't pay their suppliers, they can't meet their obligations. Why else do businesses stop paying their obligations?
Yeah, it's I mean, certainly at the small business end, you know, they go in, they start a business with an idea and a passion to do something. They don't necessarily think that much about administration, and you know, they don't have an accounts payable department. You know, there's nobody there to pay the bills. You know, maybe it's the other half or the partner that's doing that, but often they're just so busy on the tools. You know, and guess, you know, what we've seen is that it's when their inboxes are full and their head is full of projects, paying the bill sort of falls down the list, unless they're sort of being, you know, receiving that text message or a phone call to say, hey, we did send you an invoice, we would like some money. You've really got to get on their radar because they're just so busy. And then sometimes, yeah, they don't actually have the cash. So cash flow management is not a strong suit of a lot of business owners. They learn it the hard way, I think. Unplanned overdrafts and credit card extensions to try and buffer things. So, you know, being proactive as a business, getting in touch with the people that are struggling to pay you, at least to get something coming in. So communication is key with these guys.
Now, I beg your pardon, at the start of the session, I introduced now CreditorWatch Collect as a tool to automate invoices, but it's actually all about automating collections. So maybe you could tell us a little bit about Debt or Daddy, now CreditorWatch Collect, and how it works.
Yeah, absolutely. So, I mean, really the goal with, there's kind of two camps. We've got the small business, and we help small businesses extremely well, but we also help the larger businesses, and the problems are a little bit different. So with smaller businesses, they struggle for time, and they also hate asking their customers for money. As a rule, they don't have time. Some people find it really stressful to have that conversation, to ask for money. And when they went into business, they thought they could make sales and money would come in, but turns out that's not always true. So we're giving them tools. First up, we automate, you know, email reminders, SMS reminders, and we give them a really solid process that helps them manage their accounts receivable. So it's a plan and the software to help them follow the plan and make it super easy. And it's basically turnkey, and it has significant results. And you know, they go from nothing and sticking my head in the sand or avoiding the problem, put in some good software, cash comes in quicker. It's very straightforward. And then at the larger end, really you're looking at efficiencies. You know, we've looked at there is that labour market shortage. It's hard to find good people, and you know, a lot of people are using software and spreadsheets that are not built for collections. And I'm showing it to people in recent weeks, and they're going, "Wow, there is actually a better way." So for larger businesses, it's about efficiency, it's about team happiness, but also improving the collection rate, you know, significantly.
So one of the things you obviously do is you automate that collection process, which is so manual in a lot of businesses. What benefits does that automation deliver to the people that use your system?
Yeah, well, long story short, cash in the bank. I mean, one of our a recent customer of ours that actually just acquired another business, and it was, you know, they're serving the hospitality industry, which is quite a tricky one to get your cash out of. So very high volume, you know, about close to 2,000 customers, lots of smaller invoices, but they really start to add up. And this was off the back of COVID, and you know, the hospi was hurting. But they and their credit manager or collections person was struggling to get across this new book of debt. They couldn't get to every invoice and every account. So, you know, they switched us on. We had them up and running in a couple of weeks, and their bank account was going up by 17 grand a day. Like, they could see the difference as cash would start to come in. They started to get feedback around some disputes and things, so they could resolve those and unlock that cash. And by the end of, say, 3 months, the CFO, she calculated they would be able to save half an FTE because they were able to repurpose their staff. So, you know, the impact is huge when you put good process and automation into a business.
Automation is just one part of the, you know, collections jigsaw. What's your advice to businesses to put other steps in place so that they can streamline that collections process other than automation?
Yeah, sure. So one thing that we see quite a lot, businesses come to us a bit too late. You know, they've got a chunk of cash sitting in plus 90 days. That money's probably run off. They've got really poor, say, contact details. There's no mobile numbers. Sometimes they don't even have an ABN, you know, like it's risky business to operate how they've been doing that. So, you know, if we were able to wind back the clock, you would go, when you first made a sale, when you onboarded that customer, you would capture all of the details, you know, the directors' names, mobile numbers. They'll quite happily surrender those at that time, let alone when they owe you 20K, right? So, you know, with the credit application process, you know, CreditorWatch of the Apply Easy product, you're capturing really good data right at the beginning that flows straight through, so you can use it later on if you need to. You've got the credit risk checking. So, you know, long story short, defense is your best offense. You know, put those things in place at the beginning, then, you know, you can be proactive and really good at communicating throughout the credit control process when you need to. But that's, you know, don't create that problem for yourself, you know, like really start strong and set yourself up to succeed is my advice on that one.
I think the Socceroos were pretty good at that this morning, the defense is the offense. So thank you so much, Matt. I'm now going to ask Patrick to come back into the session to run a few Q&As from the audience. Over to you, Patrick.
So thank you. Thanks for that, Matt. Good to see you again, mate. And yes, go the Socceroos. How good was that? There's actually no questions that have come in. So that either means that we've done a phenomenal job answering everyone's questions before they ask them, or everyone's being really shy. So we may look to actually wrap it up at this point. I do, however, have a poll to run, which I'll do. So if anyone does have questions, please pop them into the GoToWebinar control panel. I'm going to run a poll in the meantime off the back of Matt McFedries' presentation there. Would you like to hear more information on CreditorWatch Collect, or have you got any general inquiries? If you let us know, say yes, we will be in contact with you regardless of whether it's for CreditorWatch Collect or any of our products or any questions that you might have. If you want introductions as well to anyone on the panel, John, Nick and Roberto, you can also hit yes and we can facilitate that for you. We've obviously got a lot of people on here, so it's always good to be able to target that. And I'll just let that run for another few seconds. No questions coming in, Ali. So are you happy for me to wrap that up? I would assume that's a yes. I know you've turned your camera off there. All right. Well, thank you everyone for joining today. If you do have any questions in the meantime, don't be shy to get in contact with us. The other thing, of course, is we do have the Risky Business white paper that is available to be downloaded. Please go to creditorwatch.com.au, and if you go to the News Hub in the header and click on downloadable resources, you will see that the Risky Business white paper is there for you to download. A really good piece of content that you can utilize as well within your own business. So thanks everyone again. Have a fantastic summer for those of you in Australia. I don't know how many international fans we have. Be safe and have a Merry Christmas as well. And we will see you in the new year. Thanks very much, everyone.